Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
Hello and welcome to the Global View on this Monday. I'm Andrew Gagan. Good to have you with us. Let's check what's going on at a macro level. US consumer sentiment has improved dramatically in the past month, with the University of Michigan Sentiment Index up more than 12.5% this month to hit the highest reading since September 2021. And one-year inflation expectations inched up to 3.4% this month from 3.3% in June. And in the latest indication that inflationary pressures in the US economy are abating, import prices fell for a second straight month in June, as an increase in the cost of fuel was offset by declines elsewhere. So those rising inflation expectations saw Treasury yields move higher, but they remained lower over the week as investors anticipate that the monetary tightening cycle is near an end. 10-year yields rising to 3.8% and the 2-year up 14 basis points to 4.75%. And the US dollar bounced higher on Friday after falling sharply over the course of the past week as investors consolidated losses. The Aussie dollar, it did ease to by about 0.8%, currently trading, in fact that's wrong, it's at 68.3 US cents. Well, we are, of course, now into earnings season in the States. Citigroup, Wells Fargo, JPMorgan, they were among the first to report. Let's get across that and what else we can look at and look forward to in earnings season. Lachlan Hughes joining us from Swell Asset Management. Lachlan, great to catch up with you on a Monday morning. Thanks for joining us. So, yeah, some of the big banks already having dropped their reports. As I mentioned, JPMorgan, Wells Fargo, Citigroup. We also got the asset manager Blackrock. Broadly, what was your takeout?
Yeah, thanks, Andrew. Look, great to be with you. And that's an exciting time for us. We get to find out how our companies are traveling in the US. And I guess the key takeaways for the US banks is they're all reporting higher net interest income. And that's largely a result of rising interest rates. So, net interest income has been very strong across the board, even for a stock like Wells Fargo, who you may recall was subject to a sales scandal a couple of years ago when the CEO famously had the slogan, 80 is great, with the number of accounts they were setting up. And this was an interesting time because it actually led to a whole bunch of accounts being open without the client's knowledge, which made the asset cap be placed on them by the regulators. So despite that asset cap, even Wells Fargo grew their net interest income. And I guess the other thing which we're really looking at for now is the commercial real estate market. And it seems to be holding up at this stage, but just given the fact that a lot of people aren't returning to the office, the demand for office space does appear to be declining. And also rising interest rates is not good for property valuation. So I think it's one area that investors should be focused on. We currently don't own any of the US banks, but it'll be interesting to see as the regional banks report later this week, excuse me, how their commercial real estate book is behaving.
Yeah, in fact, we also got something of a warning too, I guess, from JPMorgan Chase Chief Executive Jamie Dimon, warning about those unprecedented economic risks ahead.
Yeah, look, absolutely. I think the economy is still the big unknown. I guess the employment data continues to surprise to the upside, but we like to look at continuing claims. And if you look at continuing claims for uninsurance, you're seeing that those rising. So look, there is people who are looking for work who can't find it, despite the fact that there's almost 2 job openings for every 1 person looking. And I think as you look out further, it gets even more uncertain. I think the consumer's getting towards the end of their line in terms of the savings that they had amassed during the COVID period. So we're cautious on the US. It really is going forward a stock picker's market.
So Lachlan, let's look ahead then, and very much towards those growth stocks and mega cap tech. And we know what's happened over the sort of first half of the calendar year with some of those huge moves, outsized gains, and I guess that also leads to outsized expectations in terms of earnings. This week we've got Tesla reporting. Also we have Meta, Microsoft. as we round out, I guess, the so-called Magnificent Seven, what are your expectations then, given how well those stocks have done this year and how those valuations are looking?
You're right, Andrew. They have done very well this year. And I think part of it, which people forget, is that there was a catch up from last year. Last year was a horrible year for technology investors. So you're seeing part of this recovery just coming back to levels where they were in 2022. But from here, I think it really needs to be driven by earnings. And if we look at advertising, that's a space that was completely destabilized by Apple's changes, privacy changes, which made measurement and targeting exceptionally hard for digital advertisers. So this affected Google, YouTube, and it also affected Meta in a substantial way. So I think what we're seeing now is, at least anecdotally, that they've made some changes by introducing AI, improving targeting and measurement, and things are improving now. So we expect to see a big improvement at the top line for both of those companies. And I think going forward, the other part that's forgotten is the cloud business. And it also slowed a little bit last quarter. It sort of dropped to, high single digit, low double digit revenue growth. And we think the cloud will continue to sort of sit around these levels, but we still feel very bullish about the cloud. It's a long-term structural driver. We see only 10 to 15% of workloads transition to the cloud at this stage. So we see a very, very long road ahead for these cloud businesses, despite the fact that the next couple of quarters may be unpredictable.
So, I mean, it's certainly pointed out that there's been a lot priced into these mega caps. The question is, are they overvalued at these levels?
Yeah, we think they are. If you're taking the long-term view as we are, we think they're exceptional value. Going forward, with inflation starting to moderate, you're going to have to look for companies that have structural growth drivers. So, certain stocks, whether they be consumer staples like a Pepsi or a Coca-Cola, these companies have over the last couple of years put through very, very high price increases into their products, which is why their revenues have been growing. If you take out the price increases, the volumes have been shrinking. And going forward, as inflation moderates and competition seems to pick up, we expect these companies' revenue growth to be challenged. But big tech companies with these long structural growth drivers like digital advertising, like the cloud, and also AI, we see them as very good value at today's levels.
Lachlan, given that narrow leadership that we've been talking about as far as the so-called Magnificent Seven are concerned, do you think their outlook is likely to determine, the path of this year's equity rally as we move into the second half of the calendar year?
Yes, I do. I think it'll be earnings driven. But the beautiful thing about these two companies are, when you look at, or even Amazon, Google, or Facebook, there is a lot of potential to take costs out of the business. And we've seen that starting to happen. It really kicked off by, Elon Musk and what he did with Twitter. And you've heard Mark Zuckerberg talk about the year of efficiency. Well, Google's looking at a year of efficiency as well. And Microsoft is also pruning the expenses where they can. So yes, look, it's important that revenue continues to grow, but we shouldn't forget that there's another cost lever there, another driver there, and that's the cost lever. And they are bringing their costs down, which is another way of growing your earnings.
AI. Now, of course, that has been the big theme for the first half of the year as well, given what we've seen, and we sort of feel as though we're on the cusp of something of a revolution here. So, Lachlan, how are you seeing AI play into what you've just spoken of, particularly those larger companies that are leveraging it, the likes of Microsoft and Alphabet in particular?
Yeah, well, we believe the best way to get exposure to AI is to buy these large cloud companies, which is Microsoft Azure, it's Google, and it's Amazon Web Services. And we like all of those businesses because they're actually providing the foundational layer. So they're providing the infrastructure, which these AI services will run on top of. So effectively, those companies own the train tracks. And at this stage, it's very hard to know what trains are going to be traveling across these tracks. But if you own that foundational layer, you'll get very good exposure. If we look today, there's nearly 15 tech unicorns. That's companies valued at over $1 billion in AI. So there's been a lot of hype. There's been a lot of money flowing into these unicorns. But we would say at this stage, very, very, very hard to pick the winners in AI. So we think the best way to play it is to own the infrastructure layer, own the train tracks, and just see what innovation comes on top of that over time. And I think that's the safest way to play it. But you don't forget as well that these companies are also integrating AI into their own services. And for a company like Microsoft, they're continually adding AI into their productivity suite. It's in testing at the moment. We expect it to be rolled out in the coming months. And this is another potential for them to raise their prices over time. So Microsoft, you get sort of two bites of the cherry. You get the bite at in terms of like the AI infrastructure that they're providing to third parties, but also the AI they're incorporating into their own products. And look, these companies are so big with such deep expertise in this area, they can do things that their competitors can't. And that's why we like to own the biggest companies in the world, because they're spending tens of billions of dollars in research and development, and it's very hard for smaller companies to compete with.
Yeah, and of course, given that the expectations of AI, that's why we've seen the likes of Nvidia soar more than 200% in value from just the beginning of this year itself. Lachlan, just before we go, any particular view of Tesla? Of course, that is reporting this week. What are your expectations there with it's sort of delivering a record number of vehicles in the second quarter? What's the outlook?
Well, I think the deliveries keep surprising to the upside, and I think they're in a very strong position, Tesla. We don't own the company. Look, I think they're fantastic cars, and they are making big inroads into the market share of the combustion engine manufacturers. So really like Tesla, I think they're a long way ahead of the pack, but the pack's starting to catch up now, and combustion engine providers are moving into the space. We're seeing their first looks at their electric cars. So I think the competition's increasing, but I also think they're in a very strong position. We've seen Tesla cut the price a couple of times in the last 12 months, and this drives demand. So continue to think there'll be a robust demand environment for Tesla, and they're also investing in their other things, whether it's robotics, which also provides upside for investors. I think that in terms of the valuation, it's not cheap, I'll be honest, but look, they're in a very strong position, and it's a well-run company with a long runway ahead of it.
Lachlan, always great to get your view and your analysis from Swell Asset Management. Thanks for joining us. Have a great week.
Thank you, Andrew.
All right, well, let's look ahead to the week. Locally, on the data docket, we get ANZ Roy Morgan's weekly read on consumer confidence. Tomorrow, the focus, though, will be on the minutes of the RBA's July meeting. And then later in the week, we get skilled job vacancies and the more broader read on the labour market. Internationally, today, China releases its growth figures for June, along with the June quarter, I should say, along with retail sales. Tuesday, we see US retail sales and industrial production numbers. Wednesday, the latest inflation read out of New Zealand. And Thursday, China loan prime rates, as well as US existing home sales. All right, just before we go, a check of where we're expected to get going. Look, it's going to be a flat opening, as you can see there. SPI futures down 2 points. Stay with us. The open just around the corner.